20%. That's the share of the world's oil supply that passes through a single strip of water every day. The Strait of Hormuz, roughly 21 miles wide at its narrowest point, sits between Iran and Oman, and it's the only sea route connecting the Persian Gulf to the open ocean. Roughly 20 million barrels of crude oil and about 20% of the world's liquefied natural gas flow through it daily. When tensions in the region escalate, the headlines say the same thing every time: global oil crisis, economic shock, markets in danger. And every time, most people assume the crisis hits everyone equally. It doesn't. That assumption is 20 years out of date. And the gap between the old story and the new one is where the real information lives. I'm Warren. Last video we covered Japan and the carry trade unwind, an external threat to the financial system built over 30 years. Today is a second external threat, but this one has a twist. Because unlike Japan, where the risk is structural and affects everyone, the oil story has a winner and a loser. And understanding which side of the trade the United States sits on in 2026 changes how the crisis looks entirely. The old story goes like this. Instability in the Middle East disrupts oil supply. Prices spike globally. The United States, a major oil importer, absorbs the shock through higher gas prices, higher transportation costs, and higher inflation. The economy slows. Consumers pull back. Recession risk rises. That's the version that played out in the 1970s, in 2008, and in the popular imagination ever since. And 20 years ago, it was accurate. In 2005, the United States imported roughly 60% of the petroleum it consumed. A supply disruption anywhere in the chain was a direct hit. But that version of the world doesn't exist anymore. Over the past 2 decades, the shale revolution unlocked massive domestic reserves. American oil production doubled, then tripled. And by 2023, the United States became the largest oil producer in the world, surpassing both Saudi Arabia and Russia. The country went from importing 60% of its oil to producing more than it consumes. The entire energy equation flipped, and that flip changes who wins and who loses when the Strait of Hormuz becomes front-page news. If you've been watching headlines about the oil crisis and feeling anxious about what it means for the economy and for the index fund sitting in the Roth IRA, this flip is the single most important piece of context. The United States in 2026 is not the United States of 2005. The country is a net energy exporter. It produces roughly 13 million barrels of crude per day. It exports more liquefied natural gas than any other nation. When oil prices spike, the macroeconomic effect on the United States is mixed, not catastrophic. Consumers pay more at the pump, but energy companies earn more. Exporters earn more. Tax revenue from the energy sector increases. The S&P 500 contains those companies, and the portfolio built in Video 10 holds the S&P 500 through VTI. Here's the part most coverage skips. Of all the oil flowing through the strait, only about 2% goes to the United States. The vast majority, roughly 75%, goes to 4 countries: China, India, Japan, and South Korea. China alone imports about 11 million barrels per day, and a significant share of that comes from the Persian Gulf. For the United States, a strait disruption is a price problem. Oil is globally priced, so when supply tightens anywhere, crude prices rise everywhere. American consumers pay more at the pump. That hurts, but it's manageable, especially when the same price increase generates revenue for American producers, American energy companies, and American LNG exporters. For China, it's different. It's not just a price problem, it's a supply problem. And those are fundamentally different things. A price problem slows an economy down. A supply problem can break one, because China doesn't just consume energy, it runs on it. Manufacturing, exports, industrial output, the core of China's economic engine depends on a constant flow of imported oil and gas. When that flow gets restricted, factories slow, energy gets rationed, and production stalls. The same event produces 2 completely different outcomes depending on which side of the import-export line a country sits on. There's a second layer that most oil crisis coverage ignores entirely. Natural gas. The Middle East is one of the largest exporters of liquefied natural gas in the world. Qatar and the United Arab Emirates send over 90% of their LNG exports through the Strait of Hormuz. If the strait tightens, it's not just crude oil markets that react. LNG markets react too. And this matters because natural gas powers electricity generation, heating, and industrial processes across Asia and Europe. A disruption to LNG supply doesn't just raise energy bills. It threatens the basic functioning of power grids and factories in countries that depend on imported gas. Over the past decade, the United States has quietly become the largest exporter of liquefied natural gas in the world. The same dynamic repeats. One region loses supply, another region steps in to sell it. American LNG terminals on the Gulf Coast are operating near capacity, and new export facilities are coming online. When Middle East LNG supply tightens, European and Asian buyers turn to American suppliers, and the pricing power shifts to U.S. exporters. If you've been watching energy company stocks climb during periods of Middle East tension and wondering why, this is the mechanism. Scarcity in one geography creates pricing power in another, and the companies that benefit, the pipeline operators, the LNG terminal owners, the integrated energy majors, are all components of VTI. The index fund holds them. The investor who owns VTI participates in the upside without having to pick which specific company benefits most. That's the structural advantage of the index. It captures the winners automatically. China saw this vulnerability coming. They've spent years building safeguards, diversifying import sources to include Russia, Brazil, and Venezuela, building strategic petroleum reserves estimated at roughly 900 million barrels, expanding pipeline infrastructure that bypasses maritime choke points entirely, including the Power of Siberia pipeline from Russia and the China-Myanmar pipeline from the Indian Ocean. Those hedges are real. They buy time. But they don't eliminate the exposure because the volume of oil China needs is too large to fully replace through alternative routes in the short term. In a brief disruption lasting weeks, China absorbs the shock from reserves. In a disruption lasting months, reserves deplete and the structural pressure builds. 900 million barrels sounds like a lot. At a consumption rate of 15 million barrels per day, that's roughly 60 days of coverage. 2 months. After that, the economy starts feeling the squeeze in ways that don't show up in headlines for weeks, but show up in factory output, shipping volumes, and export numbers almost immediately. And when structural pressure builds in the world's second largest economy, the ripple effects touch every market on the planet, including the one where VTY and VXUS sit. If you hold VXUS, which includes significant Chinese and Asian equity exposure, a sustained strait disruption affects that portion of the portfolio directly. That's not a flaw in the portfolio. It's the cost of international diversification, and the benefit is that the same disruption that weakens Asian equities strengthens American energy stocks within VTI. The portfolio was designed to hold both sides of asymmetric shocks. This is one of those shocks. Here's the geopolitical layer that almost nobody in personal finance discusses, and it connects the oil story to the Japan story from last video in a way that matters for anyone building long-term wealth. The Strait of Hormuz escalation didn't happen in a vacuum. It happened during a period of intensifying trade negotiations between the United States and China. Tariffs, technology restrictions, supply chain decoupling. For years, the economic relationship between the two largest economies has been slowly unwinding. And if negotiations are partly about leverage, then leverage comes from pressure. Economic pressure, market pressure, and sometimes energy pressure. When one country can tolerate a shock that the other country can't, the shock itself becomes a negotiating tool. The crisis stops being about oil and starts being about positioning. And the country that produces its own energy, exports it to others, and controls its own supply chain sits in a fundamentally different chair at the negotiating table than the country that imports 11 million barrels a day through a 21-mile-wide choke point. If you're wondering why this matters for a personal finance channel, the answer is the same as last video. Geopolitical positioning determines capital flows. Capital flows determine interest rates. Interest rates determine asset prices. And asset prices determine what the number in your Roth IRA does over the next 20 years. The straight line from the Strait of Hormuz to the balance in a Fidelity account runs through bond markets, currency markets, and equity valuations. Every video in this series has been building a portfolio designed to survive and compound through exactly these kinds of structural shifts. The shift is happening. The portfolio was built for it. Now, what does this mean for the person watching this video with a Roth IRA, a VTI position, and a split deposit running every 2 weeks? 3 things. First, the VTI position includes American energy companies. When oil prices rise, energy sector earnings rise. The S&P 500 has a roughly 4 to 5% weighting in the energy sector. During oil price spikes, that sector outperforms, partially offsetting the drag that higher energy costs create for consumer discretionary and transportation stocks. The index absorbs the shock internally. That's one of the structural advantages of holding the entire market instead of picking sectors. When one sector loses, another gains, and the total balance is less volatile than any individual component. Second, the VXUS position, which holds international stocks, has significant exposure to Asian economies that are disproportionately affected by energy supply disruptions. China, Japan, South Korea, and India make up a substantial portion of VXUS. In a sustained Strait disruption, those economies slow and their stock markets reflect it. This is the price of international diversification. The portfolio participates in the downside of regions under pressure. But over long periods, international diversification reduces total portfolio volatility because the shocks are asymmetric, meaning they don't hit every region at the same time. The same disruption that weakens Asian equities strengthens American energy stocks. The portfolio balances itself. Third, if you hold BND or a bond allocation from the portfolio in video 10, oil shocks create an interesting dynamic. Higher energy prices can push inflation higher, which puts upward pressure on bond yields and pushes bond prices down in the short term. But oil shocks also create recession risk in energy importing economies, which drives a flight to safety into U.S. Treasuries, pushing bond prices up. Those two forces partially offset each other. The bond allocation does what it was designed to do: dampen volatility without eliminating returns. The protocol for an oil crisis is the same as the protocol for the Japan carry trade unwind, and the same as the protocol for every market disruption this series has covered. Don't sell, don't rebalance in panic, don't move to cash, don't chase energy stocks after the price has already moved. If you're tempted to buy individual energy stocks because the headlines are screaming about oil prices, remember the rule from every video in this series: the index holds the energy sector already. Buying individual stocks on top of VTY is doubling down on a single sector, which introduces concentration risk that the diversified portfolio was specifically designed to avoid. The portfolio from video 10 was built to absorb exactly this kind of event. The diversification across domestic equities, international equities, and bonds creates a structure that self-balances through asymmetric shocks. The automatic contribution from video 8 continues buying shares at whatever price the market offers, which means a dip is an opportunity, not a loss, for the person who keeps contributing. A 5% market drop during an oil spike means the monthly $500 buys more shares of VT1 at a lower price. Those shares, purchased during the dip, compound for every remaining year of the investor's timeline. The person who panicked and paused contributions during the dip missed the discount. The person who didn't notice, because the transfer was automatic, bought it. The real risk in an oil crisis isn't the crisis itself. It's the investor's reaction to the crisis. Every major disruption in market history, 2008, 2020, the carry trade unwind of 2024, followed the same pattern. The event happened. The headlines screamed. The investor who sold locked in losses. The investor who held and continued contributing recovered and compounded. The Strait of Hormuz is the same story with different geography. The architecture holds. The person who built it just has to let it work. If you're watching this video and your first instinct was to check the portfolio, open the brokerage app and consider making a change, that instinct is the threat. Not the oil, not the Strait, not China. The instinct to react. The portfolio doesn't need protection from an oil crisis. It needs protection from the person who built it deciding to intervene during one. Next, the internal threat. Not Japan, not oil. Time. Why the 40s are the last realistic window for building meaningful wealth, and what happens to the compound curve when the runway shortens. External threats test the portfolio. The internal threat tests the person.